European stock indices advanced to fresh all-time high levels on Friday on the back of dovish central bank hints, while the S&P 500 gained for the third straight week in the US on the back of an unsustainable appetite for the big US companies and their stocks despite hawkish Fed comments. But the new week starts with just a limited risk appetite as investors around the world are holding their breath ahead of the most important US inflation data release this week. So, welcome to the new week of trading with Swissquote's daily market talk. So we had a few central bank decisions and data points here in Europe that gave a hand to the central bank those last week. Among them, the Riksbank decided to cut its interest rates last week, remember, as expected, and signaled 2 more interest rate cuts this year. And the Bank of England hinted at an upcoming summer rate cut in the UK that could be announced as early as their June monetary policy meeting. And the probability for that is around 50%. And a cherry on top, the UK has exited recession in the first quarter of this year. And the Bank of England sees a small but steady growth for the quarters to come. So, the FTSE 100 index closed last week on a fresh record high. The Stoxx 600 index also closed last week at a fresh all-time high, as the European Central Bank is also expected to cut its rates in June. The euro-dollar bounced lower from the 50 and 200-day moving averages, while cable tests its own 200-day moving average to the upside again this morning in Asia, but it will take a bit more than just improved growth numbers to clear these important resistances this week in the European currencies, because the US inflation numbers are due this week, and they may throw these currency pairs toward one direction or the other, but with the risk of seeing a stronger US dollar after the US inflation data release than the contrary, because things in the US are not exactly going toward the right direction. Released on Friday, the US Michigan sentiment and expectations numbers were pretty much a disaster, really. Not only the data show that sentiment in the US tanked in the month of May, but the series of data also pointed at rising inflation expectations in the US for the next year to 3.5%. So that's obviously pretty much in line with where the US CPI has been stagnating since the end of last summer. And worse, the core CPI in the US, which excludes uses stuff like food and energy that no one really needs in the economy, is coming down slowly, but really slowly, because the index is sitting just a touch below the 4% level at the moment. That's almost twice the Federal Reserve's 2% inflation target. And obviously, the unideal inflation dynamics explain why the Fed won't be in a position to cut its interest rates soon. And this is obviously something that the Fed members repeat each and every day since the latest FOMC meeting, though nothing really tells us why the Federal Reserve is still willing to start unwinding its huge balance sheet regardless, because inflation is not returning to the 2% target anytime soon. Even the super core measure of inflation that excludes food, energy, and shelter this time was up by 8% in April in 3-month annualized pace. That's really bad. And US consumers continue to spend, although the credit card delinquencies and the buy now and pay later schemes are on the rise. And the major US stock indices are at the record high levels, as you know, despite all of these unideal news, because the earnings have been robust, at least for the big technology stocks. So it is in this tense and uncertain conditions that the US inflation data will land on the market this week. A consensus of analyst estimates on Bloomberg survey points at a small improvement in both the headline and core inflation measures in the US. If that's the case, investors could breathe a sigh of relief this week and enjoy the dovish news from at least other central banks around the world. We would then see the euro and sterling, for example, extend their gains against the US dollar. The US yields ease a little bit and the stock markets continue to surf on a fresh wave of optimism. But if these inflation numbers surprise to the upside for the fourth straight month this year, then it will be hard to keep these Federal Reserve hawks contained. Now the US dollar index kicks off this week a touch above the 105 psychological level. The S&P 500 is just a spitting distance from an all-time high level as well. The US 2-year yield spiked to 4.87% level on Friday, and activity on Fed funds futures now gives around a 60% chance for a September rate hike from the Federal Reserve. So obviously it will be very interesting to see how the things or these numbers and these metrics will evolve from now to the end of this week. But I am afraid that there is a chance that we see another bad surprise on the inflation front, given the surge in many regional Fed surveys, and some people out there also warn that the shipping costs, remember the shipping costs tend to show with around 6-month delay in these inflation indices, and well, we are getting closer to that 6-month point. Happily, the crude oil chart gives some hope to investors and to the Fed does regarding the energy inflation, because the barrel of US crude fell 1.75% on Friday's trading session and slipped below its 100-day moving average. The price of a barrel has been unable, in fact, to make a move above the all-important $80 per barrel level since it fell below this level at the start of May. Yet, the geopolitical tensions in the Middle East remain high, as Israel doesn't really listen to ceasefire calls from the US and the rest of the world. The US, on the other hand, doesn't really know what to do exactly with this situation. They can't really turn their back to their strongest military ally, but the situation in Gaza and the rising protests against Joe Biden give a very sour taste to Biden's election campaign this year. So Joe Biden, who is actually stuck between a rock and a hard place, vents his frustration on China, and it is said that Joe will be doubling or tripling or even quadrupling levies on some Chinese goods, and well, the Chinese electric vehicle makers will be part of that plan. So let's see if that could divert some of the attention from Gaza to China, but the situation is complicated. China, on the other hand, continues to struggle with its own demons. Released during last weekend, while the latest data show that consumer inflation in China rose more than expected in April to 0.3% on a yearly basis. That's still very much poor, but producer price deflation continues with a 2.5% retreat in April. And more disquietingly, the aggregate financing in China fell for the first time in history on the back of slower government bond issuance and also on the back of a decline that we saw in shadow banking. So the Chinese CSI 300 index is up by nearly 18% since the February dip, has also on the back of some stimulus measures. UBS and BNP upgraded their view on MSCI China recently, but the rally in Chinese stocks remains on a slippery path still, in my opinion, given all these geopolitical challenges that do result in a deepening trade and technology war for China that's also struggling with a deepening housing crisis. Elsewhere, the earnings calendar is busy this week with US big retailer earnings due ones after the others. The Chinese Alibaba, on the other hand, will also be reporting its own quarterly earnings. OpenAI is expected to announce some updates this Monday. And finally, Alphabet's Google hosts its annual developer conference this week, which, well, could bring plenty of AI news on the headlines. But this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.